Credit cards are one of the most widely used financial tools in the United States. They are used for everyday purchases such as groceries, fuel, dining, online shopping, subscriptions, travel bookings, and emergency expenses. For many people, credit cards are an essential part of daily financial life. Despite their widespread use, credit cards are often misunderstood. Many people use credit cards for years without fully understanding how they work behind the scenes. This lack of understanding can lead to confusion about interest, fees, billing cycles, credit scores, and long-term financial consequences. In this video, we will clearly explain how credit cards really work in the United States. This content is for educational purposes only and is based on publicly available information. A credit card is not free money. In the United States, a credit card is a revolving line of credit issued by a bank or financial institution. When you use a credit card, you are borrowing money from the issuing bank. The bank pays the merchant on your behalf and you agree to repay the bank later. Each purchase creates a short-term loan that remains outstanding until it is paid. Unlike installment loans, credit cards do not have a fixed repayment schedule. As balances are paid down, available credit becomes available again. This revolving structure is what makes credit cards flexible but also complex. When a credit card is used, more than just the cardholder and the bank are involved. A typical transaction includes the cardholder, the merchant, the issuing bank, and a payment network. Payment networks help route information between banks and ensure transactions are processed securely. They do not usually lend money directly to consumers. A credit card transaction does not occur instantly. First, the transaction is authorized. During authorization, the bank checks whether the card is valid, whether enough credit is available, and whether the transaction appears legitimate. Next, the transaction is posted to the account. Finally, the transaction is settled, meaning funds officially move between institutions. This multi-step process explains why some transactions appear as pending. Every credit card has a credit limit. The credit limit is the maximum amount the bank allows the cardholder to borrow at one time. If a credit card has a limit of $3,000 and $900 is spent, $900 of the bank's money is being used. $2,100 of available credit remains. Credit limits exist to manage risk. They also play a role in credit utilization, which is used in credit scoring models. A higher credit limit does not represent income. It represents borrowing capacity. Credit cards operate on monthly billing cycles. A billing cycle typically lasts between 28 and 31 days. At the end of each billing cycle, the bank generates a credit card statement. The statement summarizes purchases, payments, fees, and interest. It also shows the statement, balance, minimum payment, and payment due date. Two dates matter most. Credit card interest is expressed as closing date marks the end of the billing percentage rate. The payment due date is shown as a yearly figure. Statement balance. Interest is usually if the statement balance daily. Is paid in full when a balance due date, carries past the payment typically avoided. Daily interest begins if it is not paid on the unpaid amount. Interest may apply. This daily interest many continues until the balance is balanced with the current because balance. Interest compounds over time. Balance reflects what was owed at the end of the billing cycle. Most credit cards offer a grace period on purchases made after the statement period closed. Is the time between the interest statement is generally calculated based on unpaid statement balances, not on new purchases. This distinction explains why statement timing matters. Paid in full. If a balance is carried forward, the grace period may be lost and interest may begin accruing immediately on new purchases. Every credit card statement includes a minimum payment. The minimum payment is the smallest amount required to keep the account in good standing. Making the minimum payment prevents delinquency, but it does not eliminate debt quickly. Interest continues to accrue on the remaining balance. Minimum payments exist primarily to keep accounts current, not to eliminate balances efficiently. In addition to interest, credit cards may include various fees. Common fees include late payment fees, annual fees, balance transfer fees, and foreign transaction fees. Not all cards have the same fee structure. Fee details are disclosed in the card's terms and conditions. Banks make money from credit cards in several ways. One major source is interest paid on carried balances. Another source is fees. Banks also earn money from merchant processing fees. When a credit card is used, the merchant pays a percentage of the transaction amount. Even cardholders who never pay interest still generate revenue for banks through transaction fees. Credit cards may also offer rewards such as cashback, points, or miles. These rewards are funded primarily through merchant processing fees and interest paid by other cardholders. Rewards programs are designed to encourage spending and card usage within the credit card ecosystem. Credit cards also allow dispute and chargebacks. A dispute occurs when a cardholder questions a charge due to unauthorized activity or billing errors. If a dispute is filed, the bank investigates and may temporarily credit the account while the
Credit
issue
card
is reviewed.
activity is reported to credit bureaus on a regular basis, typically once every month. Banks and card issuers send detailed updates about each credit card account, including the current balance, credit limit, payment status, and whether the account is open, closed, or delinquent. This information becomes part of a person's credit report and is used by credit scoring systems to evaluate credit behavior. Several important factors are tracked through credit card activity. One of the most significant is payment history. Payment history reflects whether payments are made on time, paid late, or missed entirely. Because credit cards report activity frequently, they create a continuous timeline of payment behavior rather than a one-time snapshot. Over months and years, this allows lenders to see patterns, consistency, and changes in behavior. Another key factor is credit utilization. Credit utilization measures how much available credit is being used compared to the total credit limit. For example, if a credit card has a limit of $5,000 and a balance of $1,000, the utilization reflects that portion of available credit in use. Because credit card balances can change throughout the month, utilization provides insight into how credit is managed over time rather than just at a single moment. Account age is also tracked through credit card activity. Account age reflects how long credit accounts have been open and active. Credit cards are often kept open for many years, which allows credit bureaus and lenders to see long-term behavior. Older accounts provide historical context, showing how credit usage and payment habits evolve over time. Because credit cards report information continuously, they are one of the most influential tools used in credit scoring systems. Unlike installment loans, which have fixed payments and eventually end, credit cards remain active as long as the account is open. This ongoing reporting makes credit cards especially valuable for evaluating long-term credit behavior. Credit cards differ significantly from debit cards, even though they may look similar and are often used in the same places. A debit card pulls money directly from a checking account at the time of purchase. When a debit card is used, funds are immediately removed from available cash. A credit card, by contrast, borrows money from a bank and creates a balance that must be repaid later. Because credit cards involve borrowing rather than direct spending, they function as credit accounts rather than payment tools.
This difference explains why credit card usage is reported to credit bureaus while debit card usage generally is not. Because credit cards involve borrowing, they also include different consumer protections compared to debit cards. Credit card systems are designed with dispute processes that allow transactions to be reviewed, reversed, or temporarily credited while issues are investigated. Debit card transactions usually follow different rules and timelines. There are many common misunderstandings about credit cards. One widespread belief is that carrying a balance is necessary to build credit. Another belief is that using a debit card helps improve credit scores. These ideas are common, but they do not reflect how credit reporting systems actually work. These misunderstandings exist largely because credit systems are rarely explained clearly. Many people begin using credit cards without being taught how reporting, scoring, and billing operate. As a result, people often rely on assumptions, incomplete advice, or trial and error instead of clear explanations. Credit cards are widely used in the United States because they are convenient and accepted almost everywhere. They allow purchases to be made without immediate cash and provide short-term borrowing flexibility. Credit cards are also commonly used for online shopping, travel reservations, subscriptions, and recurring payments. Beyond convenience, credit cards play a central role in establishing and measuring credit history. Because they report activity regularly and remain open for long periods, they provide lenders with detailed information about borrowing behavior across time. This makes credit cards one of the most important components of a credit profile. Credit cards are powerful financial tools, but they are also complex systems involving banks, payment networks, merchants, and credit bureaus. Each participant plays a role in how transactions are processed, how data is reported, and how credit behavior is evaluated. This video explained how credit cards work in the United States, from transactions and billing cycles to interest, fees, rewards, disputes, and credit score impact. In future videos, we'll cover these topics in more detail. Thanks for watching.